Today we will discuss about the Treasury Bill. What is a Treasury Bill? Treasury bills are money market instruments issued by the Government of India. That is, first of all, it is a money market instrument. It is issued by the Government of India as a promissory note. That is, it is like a promissory note with guaranteed repayment at a later date. That is, it is a money market instrument. It is issued by the Government of India. It is a promissory note with a guaranteed repayment at a later date. That is, it will be repaid at a later date with a guaranteed amount. This is the Treasury Bill. Funds collected through such tools are typically used to meet the short-term requirements of the government. That is, these types of funds are usually used to meet the short-term requirements of the government, hence to reduce the overall fiscal deficit of the country. These treasury bills are mainly used for meeting the short-term requirements of the government and also to reduce the fiscal deficit of the country. They are primarily short-term borrowing tools having a maximum tenure of 364 days, available at zero coupon or zero interest rate. That is another important feature. That is, first one, it is a money market instrument. Second one, it is issued by the Government of India. Third one, it is a promissory note. What is promise? Promise to or it guarantees the repayment of a specified amount at a later date. And next one is that it is used for meeting the short-term requirements of the government. These short-term requirements is to meet the overall fiscal deficit of the country. Next important one, this is a short-term borrowing tool and its maximum period is 364 days or 1 year. And another important feature is that it is available at zero coupon or zero interest rate. Here, in the case of the treasury bills, the government won't provide any interest rate. There will be no interest rate for the treasury bills. And here the advantage is that the government issues these bills, treasury bills, at a discount rate, and the full amount can be availed by the investor when they sell the securities or when they sell the treasury bills. That is, we can purchase these treasury bills at a lesser value than the face value of the treasury bill, and we can sell them at the actual value or at the face value when the maturity or at the time of the maturity date. That is, in the case of the treasury bills, there won't be any interest, or the government will not provide interest. They provide the full value at the time of the selling of the treasury bill or when we sell. A short-term treasury bill helps the government to raise the fund to meet its current obligations, which are in excess of its annual revenue generation. That is, these treasury bills are used by the government when the generation of revenue are lesser than the expenditure. And its issue is aimed at reducing the total fiscal deficit in an economy and also in regulating the total currency circulation at any given point of time. This is also used if the money in circulation is higher in the economy or if there is inflationary situation in the economy. The Reserve Bank of India also issues such treasury bills under its open market operation strategy to regulate the spread of inflation in the economy. That is, both the government and Reserve Bank of India uses this as a tools for meeting their some objectives. That is, in the case of the government, they uses it as a revenue generation or to reduce the total money circulation in the economy, and the Reserve Bank of India uses it to reduce the inflationary situation in the economy. Then features of treasury bills are given here. Minimum investment. As per the regulations put forward by RBI, a minimum of rupees 25,000 has to be invested by individual willing to procure a short-term treasury bill. Any higher amount has to be made a multiple of 20. That is, we can have a treasury bill of 25,000. Then second one is zero coupon securities, or the securities treasury bills do not yield any interest on total deposit. That is, this will not provide any interest on the total deposit. Instead, investors stands to realize the capital gains from such investment. We will get some capital gains from the investment. That is, securities are sold at a discount rate in the market. Upon the redemption, the entire par value of this bond is paid to the investors. That is, these treasury bills are sold at a discount rate in the market by the government, and at the time of the redemption or at the time of the selling, the investors get the full amount. That means there is no use of interest rate, or there is no interest gain. In the case of the government securities market, we have the capital gains in the form of the full value at the time of redemption. And we know that the maximum days for treasury bill is the 364 days. In accordance with that, the treasury bills are divided into four categories, namely the 40 days according to the dates of maturity, that is 40-day treasury bill, 91-day treasury bill, 182-day treasury bills, and 364-day treasury bill. These are the different types of treasury bills. Now, the advantages of government security, government treasury bills. That is, first one, risk free. That is, treasury bills are one of the most popular short-term government schemes issued by the RBI and are backed by the central government. That is, the risk-free. These are issued by, or short-term scheme issued by the RBI and are backed by the central government. Such a tool acts as a liability to the Indian government, as they need to be repaid within the stipulated time period. That is, it is the liability of the central government that they have to repay in the stipulated date. Therefore, it is risk free. Second, liquidity. A government treasury bill is issued as a short-term fundraising tool for the government and has the highest maturity period of 364 days. Individuals looking to generate short-term gains through secure investment can choose such funds, and also such government securities can be resold in the secondary market, thereby allowing individuals to convert their holding into cash during the emergencies. Another important is that it is highly liquid. That is, we can convert them into cash at any time as they wish. That is, this can be sold in the secondary market also. Then third one, non-competitive bidding or non-competitive bidding. That is, treasury bills are auctioned by the RBI every week through non-competitive bidding, thereby allowing the retail and small-scale investors to partake in such bid without having to quote the yield rate or price. That is, anybody can, or the investors or retail as well as small scale investors can also take part in the bidding without quoting the yield rate or the price. Then, primary disadvantage of government treasury securities is that they are known to generate relatively lower returns when compared to the standard stock market investments. They are zero coupon securities issued at a discount to the investor. Hence, the total return generated by such instruments remain constant through the tenure bonds, irrespective of economic condition, business cycle fluctuations. That is, returns will be constant, and the return will be small also. The risk also will be lower in the case of the treasury bill. These are the features of treasury bills, or the advantages and disadvantages of the importance, advantages as well as the disadvantages of the treasury bills. These are the short-term debt instruments or the money market instruments by the government.